So as you can see, I have the formulas for each of these profitability ratios listed on screen. And all of this information can obviously be found from the 3 financial documents. Next, we have liquidity ratios. Liquidity ratios are financial metrics that assess a company's ability to meet its short-term financial obligations. They measure the firm's ability to convert assets into cash quickly to recover or cover immediate liabilities. Common liquidity ratios include the current ratio, which divides the current assets by current liabilities, and the quick ratio, which excludes less liquid assets like inventory. These ratios provide insights into a company's financial health and its capacity to handle unexpected expenses or downturns. High liquidity ratios generally indicate better short-term financial stability and flexibility. However, they aren't the ultimate analysis technique for liquidity. Activity ratios. Activity ratios are also known as asset utilization ratios, and they analyze how efficiently a company manages to use its assets to generate revenue. They provide insights into how well a company utilizes its resources and operations. For example, we have inventory turnover, which measures how quickly inventory is sold and replenished, and things like average collection period. Activity ratios help businesses optimize their operations, manage working capital, and identify areas where improvements can lead to increased productivity and profitability. Finally, we have debt leverage ratios. Debt ratios are financial metrics that evaluate a company's level of debt in relation to its equity or assets. These ratios offer insights into a company's financial leverage and risk. Common debt ratios include the debt-to-asset ratio, which measures debt relative to the total assets a company has. This ratio helps assess a company's ability to handle its debt obligations and also provides valuable information for investors and creditors regarding the firm's financial stability and its transfer risk. All right, so there's nuances to these ratios. Although these ratios are super simple and easy to calculate, they aren't that useful when you're comparing firms across industries. So for example, we have Walmart and Honda. If we take the example of the liquidity ratios with the quick ratio, you can't compare Honda and Walmart. It's likely that one of the companies will have very different styles of inventory, and the ways they process their equipment is very different. However, these ratios are useful when you're comparing companies within the same industry, in the same position. All right, so now we can go through a quick, simplified version of a consolidated income statement and all these financial documents to calculate 2 ratios, the gross profit margin and the net profit margin for Tesla. So I got this data from the Wall Street Journal, and it's just a consolidated income statement of Tesla with all this information here. So to calculate the gross profit margin, I have the formula right here. So it's the revenues minus the cost of goods sold divided by the total revenues. So using Excel, we can use the minus function to take the revenues, which is right here, and subtract it from the cost of goods sold, which is right here. And this gives us 20,853. And now we can use the divide function to divide this value by the total revenues, which is the formula right here. And this gives us a gross profit margin ratio of 0.255 and so on. And now we can do the same thing with the net profit margin. But this is much more simple since it's just the net income divided by revenues. So we take the divide function and we look for the net income, which is right here. And you take this and you divide it by the revenues, which is right here again. And using Excel, we can calculate it to be 0.15446. So this is a super simplified example. The information on this Excel sheet is very basic. In reality, when you're calculating some of the other ratios, you're going to need to cross-reference these financial documents because lots of the information is located on the cash flow forecast, some is reporting the income statement, and so on. So as a result, it becomes a lot more complicated. But if you have access to all 3 of the files, which you should for publicly traded companies, you'll be able to do these calculations no problem. The next technique is horizontal analysis or trend analysis. So horizontal analysis of financial statements involves comparing financial ratios and benchmarks or any item over a number of accounting periods. This method is also known as trend analysis. So horizontal analysis allows the assessment of relative changes in different aspects of the financial statements to be seen over time. So let's look at this example. one thing to notice when you're rating these financial statements over time is that the most recent year is represented on the leftmost column and the oldest year is on the rightmost column, which kind of goes against our left to right reading style in English. So it's important to keep that in mind. But if we look at the numbers, we see a growth in the sales, a growth in the cost of sales, a growth in profit, and so on. So this can be calculated. So the change, the numerical change can be calculated and listed in this column. And the percentage change can be listed here. The percentage change is calculated by taking the difference and dividing it by the overall amount. So that's also called the year-over-year change. So returning to our consolidated income statement for Tesla that we saw in the previous example, we can see the same changes happening over time. So the leftmost column is the most recent year, which is 2022, and the rightmost column is 2018. So this records data for Tesla over the course of 5 years. Keep in mind that some of this data happened during the COVID-19 pandemic, which may have skewed results. So that shows you that it's important to realize that macroeconomic effects, like a pandemic or other industrial shocks, can affect this data. But in large, it's not that big of a contribution, at least to Tesla. So if we look, we see a growth in sales revenue. So from 21,000, 24,000, 31,000, and then rapid growth from 2020 to 2022 with 20,000 growth and then 30,000 growth. And the same processes can be seen across various other factors or various other items. And this goes to show you how this horizontal statement can be used to analyze growth over time, even with Tesla. The last tool we'll be discussing in this section is common size analysis, which is a financial The last technique we'll be discussing in this section is common size analysis. Common size financial statements show each line item expressed as a percentage of a base figure within the statement, and it's used for vertical analysis. So common size financial statements help to analyze and compare a company's performance over several periods. The common size percentages can subsequently be used to compare those of competitors and determine how a company is performing relative to the rest of the industry. A common size income statement is an income statement in which each line item is expressed as a percentage of the value of revenue or sales. A common size balance sheet is a balance sheet that displays both a numeric value and relative percentage for total assets. So in the following example, we'll be looking over a common size statement for an income statement or balance sheet. Okay, so here we have a generic example of what one would look like. As you can see, we have the normal side of a balance sheet or a statement of financial position, except one more column is added that expresses everything as percentages. In this example, you would think percentages aren't too helpful, and you'd be right. And that's because the numbers here are very straightforward. The total assets are 100,000, which makes 100%. And all these numbers are very straightforward. However, in a situation where numbers are much more miscellaneous and intricate, these percentages help to clarify much more information. Here, this is extremely helpful because it can show us what percent of our assets, for example, our current assets, are in which form. So in this example, for our current assets, the majority is in the form of total cash and inventory, whereas the rest is in the form of prepaid expenses and accounts receivables. This can suggest that the company may need to invest its total cash into other assets that can generate revenue, and it may have an inventory issue, turning inventory into actual revenue. And if we look at our non-current assets, the majority of our assets are in our plant, property, and equipment, whereas very little is in our goodwill. This can help us identify what value certain parts of our business bring and what parts aren't as helpful. So in the non-current example, we see how we have so much value in our equipment, our property, and our plant, whereas the brand name and value, which is goodwill, isn't that strong. This can also help us identify which parts of our liabilities are the greatest and which parts are the weakest, and how we can take future steps to address these and prevent any other issues from rising. This same thing can be seen for other forms of statements like the income statement, which I mentioned earlier, but it's essentially the same thing just in another financial statement. All right. So let's say you have the opportunity to install solar panels on your house. The solar panel company says it's going to cost you $10,000 to install solar panels. But they say in the long run, you're going to be able to save money. Should you make the investment? Well, in this section, we're going to be talking about capital budgeting. So what is capital budgeting? Why do we do it? And how is it done? And with these tools, we can answer whether we should make the investment for the solar panels. So first, what is capital budgeting? Capital budgeting is the process of evaluating and selecting long-term investment projects like solar panels that involve significant financial outlays. It's a decision-making process for businesses and individuals to determine which projects are worth pursuing based on their potential to generate returns or benefits over an extended period. Capital budgeting helps organizations and individuals allocate their financial resources effectively, maximizing the value of investments and minimizing the risk of making poor choices. It's a systematic approach that considers not only the immediate costs and returns, but also the long-term impact on financial performance and overall strategic goals of an individual or business. Okay, so first of all, why do companies even make investments in fixed assets? Well, investments can increase capacity, they can overcome some regulations, they are innovative, which can give companies a unique advantage, and there's so many other reasons. But why is capital budgeting important for valuation? Capital budgeting is important for several reasons, but I'll give you 3 main reasons. First of all, it helps with resource allocation. There's limited financial resources, and capital budgeting can help ensure companies focus on the most promising investments. It also helps for long-term planning. This is because it allows companies to plan for the future by considering the effects of their investment using tools that we'll discuss later over an extended period and manage risk while maximizing returns. And it also considers the time value of money, again, which we'll discuss further. But capital budgeting considers the time value of money, recognizing that $1 today is worth more than $1 in the future. This also ensures that cash flow predictions are properly discounted. Okay. So how do companies pay for investments? They pay for it in 3 ways, using cash flow, debt, and equity. So before we continue, there's 2 more concepts you need to understand before we're able to discuss capital budgeting and how to actually consider it. Internal rate of return, or IRR for short, and cost of capital. The internal rate of return, or IRR, is a finance term that helps us assess how lucrative an investment or project could be. IRR is the annual growth that an investment is expected to make. If the IRR is higher than what you could earn from a safe investment, like a bank deposit or investing in some safe stocks, then the project might be worth the risk.